Hey guys, and welcome back to another video. In today's video, as you can see on your screen right now, we're going to be talking about T-bill ladders again. And we're also going to be including a little bit about CD ladders as well. Now, we've talked about this in the past, but today specifically, I'm going to be explaining how you can have this done for you completely automatically. Sometimes the setup for this is a little bit tricky or it takes a little bit time to get it going. But as I was looking around in my investment account today, I discovered a feature that could be helpful for you if you're looking to set up a ladder of some sort. First though, let's do a quick overview of what a Treasury bill ladder or a CD ladder might look like, the basic concept behind it. So in this first visual here, we have year one, basically today. If we were to start it and we have our duration here on the y-axis and on our x-axis, we have in this case 4 different bonds. You can see that bond number 1 is 1 year, 2 is 2 years, and so forth. Now, if we go ahead and skip to year 2, basically 1 year later after we happen to have started it, you can see that bond 2 now only has a 1-year duration. This is obviously because 1 year of time has passed, and so bond 3 only has 2 years, bond 4 only has 3 years, but you can see that the money that we originally invested into bond 1 as a 1-year bond duration now has 4 years. And so every single year, this pattern is going to continue to where all of the bonds you lose 1 year of their duration, and the lowest duration bond is then replaced, and that money is used to buy a 4-year bond again. Now, there are a bunch of advantages to doing your investing this way, creating a ladder, but let's go over a couple of them really quick. Number one is that you get a constant flow of cash. Because these securities are expiring once a year, every single year, that means once a year, every single year, you're going to be getting paid. And so even though you have the 4-year duration, or you can do it with 13-week T-bills, so you might be getting, for example, a higher rate with those 13-week T-bills compared to another duration that you could possibly choose, but they're expiring every 4 weeks instead of every 13 weeks, making it so that you get both the higher rate and the lower amount of duration, or the amount of time that you have to wait to have your money actually come in. Number 2 is dollar cost averaging. What this basically means, it's something that we see a lot more in the stock market, but it's the idea of sort of betting on every T-bill or every bond instead of trying to pick the right one. And in the end, you're going to pick some winners, you're going to pick some losers, but it sort of averages out to the middle. You don't have to worry quite as much about rate changes because once again, you're going to hit some of the ups and you're going to hit some of the downs. And number 3, like I mentioned, was being able to respond to rate changes. This is something that's a little bit more applicable when we're talking about shorter term T-bills and being able to switch up your strategy, but it still does apply to all Treasury bill ladders. I did a whole video on T-bill ladders just about a month ago, and so I'll put a link to that right now in the top right corner of your screen if you want to go ahead and check it out. But now that we've talked a little bit about what a ladder is, let's go ahead and have a look at this feature on Schwab that allows you to do it completely automatically. So obviously, in order to use this tool, you're going to need a Charles Schwab investing account. It might be available on other platforms. I'm not 100% sure. So leave a comment down below if you know if this is available on, say, your investing platform. But in order to get to the screen, all you'll have to do is press on the trade button and then press bonds. It will take you here and you can see they show the rates for all sorts of different types of bonds, treasury securities, everything that you could ask for. But the feature that we're going to be discussing today is this button right here that says CD and Treasury Ladder Builder. When you get to the screen, it can be a little bit overwhelming at first. You can see they have some preset ladders for both CDs and treasuries, and they also have this custom ladder button. If you go ahead and click that, you can see you can select your type of security, whether you want to do treasuries or CDs, total ladder years, and number of rungs. Total ladder years would be the amount of time that you want your ladder to go for, and the number of rungs would basically be the amount of bars on your chart that you want to be going. Think of it in terms of that graph I showed you in the beginning. For example, with that ladder, we would have had 4 rungs. The next question is, how far in the future do you want to receive your first payment? That's pretty self-explanatory, but it goes anywhere from 1 to 10 years. And then coupon frequency, basically, how often do you want to be paid? With treasuries, this is obviously only at maturity versus with CDs or other things like that. It can be monthly, semi-annual. It really just depends on the ones that you want to choose. The next question is coupon frequency. Basically, this is how often you want to receive your payments. Obviously, with things like T-bills, shorter term T-bills, those are only going to be at maturity. But with things like CDs, they can go down to as frequently as monthly or semi-annual, anywhere in between. This last option between new issue and secondary issue CDs, basically the new issues are issued to you directly from the institution, and secondary issues would be purchasing off of another investor that already bought it. Now you can go ahead and play around with that custom ladder as much as you want to, but just for the simplicity of this video, we are going to pick one of the predefined ladders. And another important thing to realize, for Schwab, for example, if I try to only put in a $2,000 investment, you can see it's going to tell me that the number has to be divisible by the number of rungs times 1,000. So for this one, for 4 rungs, it's going to be a $4,000 minimum. Now, once I went ahead and entered that 4,000, selected my account and pressed next, it takes me to this page where we can see the specific rungs, or once again, the specific bars, and the different types of CDs that we can select. Now in this case, because of the type of CDs that we've selected and the duration, the amount of rungs, all of that, the coupon rate and the average rate per year are going to be the same. But make sure if you're using this to check that you're not mixing up the coupon rate and your average yearly rate. Another important thing to realize is that there's a view more results button. If you click on this and then just sort it by your average yearly rate, you can then select the highest one. It's also important to keep in mind that these are issued by different merchants, different institutions, and so when you're choosing, you might want to look at that as well. For the purpose of this video, however, I'm just going to be adding all of the ones with the highest yearly rate. So if we go ahead and do that for all of these, pressing more results, sorting it by the average yearly rate, and adding the top one, we are going to, at the end of this, see a couple of stats that it provides for us about the ladder that we have created. For this 4th rung, you can see there's actually only one option, so we'll go ahead and select that. And here you can see some of the statistics about this ladder. Our principal cost is going to be $4,000. Once again, the minimum is $1,000 per rung. The coupon percentage is 5.31%, and the average APY is 5.36, very similar. And right here, it simplifies it for us even more and tells us that the annual cash flow, the amount that will be paid per year, is $136. They even have a couple of different charts up here in the top with your estimated cash flow, showing you the interest percentage and the payment as well as the principal amount, and you can see a month by month cash out right here. Now for me personally, with my current investing situation, I'm only 21, and so I don't want to be locking up money for that long with only a 5.4% return. That is, however, a fantastic average percentage per year for someone that might be a little bit older, a little bit more conservative. But for me personally, for now, I'll stick to my shorter term treasuries as well as my stocks. I hope you did go on to enjoy today's video and learn something new. If you have any questions about how this works or any financial questions in general, make sure to leave them down below. But other than that, I'll see you in the next one.